Hello and welcome to another video in which we'll go through several steps of the accounting cycle. Let's take a quick look at the information presented. On Jan 1st, 2024, we have the general ledger of Acme Fireworks. We have these accounts with the following balances. We'll get to that in a second. We've been given the transactions for the month of January, and the first requirement is to record this in the general journal. Then we've been given 5 pieces of information and asked to do the adjusting entries, after which you prepare the adjusted trial balance, then the income statement and the balance sheet, and finally the closing entries. In this exercise, we'll also do some ratio analysis. But to get to all of that, we need to start with the very first step. And the first step would be taking these numbers and putting them into our general ledger. So let me take this information over here that we have and look at my general ledger. Now, what you will see is I've already put the numbers over here for into my various T accounts. And you will also see I have some new accounts set up over here that I will be using in the course of the exercise. So with that said, let me go back over here. And this is where I'm going to start our exercise. I will bring this over and place it here so we can see this as I work through the information. Decrease the font size slightly over here. Okay, let's get started. On the 2nd of January, I sold gift cards totaling $8,000. These gift cards are redeemable for inventory within 1 year of the purchase. So what it means is, on this date, on January 1st, or January 2nd, I received cash from customers. But this is not a sale. I've sold gift cards. But what happens with these gift cards? The people who have the gift card can come back later on and they will purchase merchandise. And when they purchase my inventory, they will not pay cash, they'll present the gift card. So until such time, these are unearned revenues. So until the customer redeems the gift card, redeems means basically uses the gift cards, it's a liability in my books. It's going to be a current liability because it's within the next 1 year, they're going to come and cash in on the gift cards. On the 6th, I purchased more inventory for $147,000. I've also been told that I use a perpetual inventory system, which means I need to debit inventory and not the purchase account. Our debit purchase if it was a periodic. So purchase debit, accounts payable credit, and that is because it's on account. My journal entry is going to be inventory debit, accounts payable credit, $147,000. On the 15th, I'm recording the sales that happened in the first half of the month. This totaled $135,000. All of it was on account. And the cost of the goods sold is $73,800. Again, since I'm using the perpetual inventory system, I will do 2 journal entries. The first one is to record the sale, accounts receivable debit, sales revenue credit. That number is given to me. It's 135. I will do a second journal entry to update my inventory records. I'm saying that this sale that I made, the cost of the inventory was $73,800. That becomes an expense. Cost of goods sold is an expense. And inventory is credited because I no longer have that with me. Then on the 23rd, I received money from customers who owed me the money. That's on account. All my credit customers, not all of them, most of them are paying me right now. So cash is debit. This money is no longer owed to me, so accounts receivable credit. Cash debit, accounts receivable credit, $125,000. Then on the 25th, I paid $90,000 to inventory suppliers on accounts payable. So people who I had purchased from, I'm paying them. So my journal entry is accounts payable debit, my liability gets decreased, and cash credit, and that amount is $90,000. On the 28th, I decided to write off accounts receivable as uncollectible. So there's $4,800 worth of receivables. I'm now saying that I'm not going to get this money. I need to take it off my books. So I'm going to credit accounts receivable, $4,800. Now the question is, what should I debit? If I were using the direct write-off method, I debit bad debt expense. But let's take a quick look over here. If you look at your T accounts, you have allowance for uncollectible accounts. So which means you need to use that account. You're closing down that contra asset account. Accounts receivable is an asset account. Allowance for uncollectible account is a contra asset account. You write it off to that, which basically means you're taking both of those off your books. On the 30th, you're again recording a sales transaction. It's not one sale, but for the second half of the month, you have sales totaling 143,000. So this is going to be slightly different than the previous one we recorded, and we'll see why that is the case. So let me highlight that over there. Accounts receivable debit sales credit is what we had done for the first half of the month. What's different over here? Sales include 11,000 for cash and 132,000 on account. So of the 143, some of it is cash and some of it is accounts receivable. Here it was all accounts receivable. So here my journal entry is going to be cash debit, accounts receivable debit, sales revenue credit. So cash is 11,000, accounts receivable is 132,000, sales revenue is 143. Now, I also need that second journal entry. Don't forget that one. Cost of goods sold debit, inventory credit. How much is that? That's 79,500. It's given in the problem. So we'll write that down, 79,500. Once again, these two journal entries, they look different. Here it was all credit sale. Here some of it is cash sale. So we did this. We have two debits and one credit over here. Okay. Finally, on the 31st, we pay cash for monthly salaries, 52,000. So this is a very straightforward journal entry. On the 31st, salaries expense debit, cash credit, and that is $52,000. So at this point of time, we've taken care of this part. The first part was record all the transactions listed above, and we've taken care of that. So let's continue with the exercise now. In part 2, we've been asked to do the adjusting entries. And the information given over here is, we have 5 pieces of information given. The first one says, depreciation on the equipment for the month of January is calculated using the straight line method. At the time of purchase, the company estimated a residual value of 3,000 and a 2-year service life. So let's first start out with writing our date. The journal entry, the accounts you debit and credit is always the same. Depreciation expense debit, accumulated depreciation credit. Now we need to calculate the depreciation. Let's see how we're going to do that. My equipment, highlighting this number over here. My equipment is $15,000. I need to calculate the depreciation expense. So I'm going to write this down over here. They've told me that residual value is 3,000. Service life is 2 years. Okay, so let me do a thing here. I'm going to show you the calculation right here where we can see it. Okay, so depreciation expense will be calculated as $15,000 minus 3,000 divided by 2. Now this is for per year, but then I need to calculate only for the month of January. So multiply by 1/12. So the original cost minus residual value divided by 2, that's per annum, then multiplied by 1/12. That's how we calculate the depreciation expense. So here what we're going to come up with is $500. So 15,000 minus 3,000 is 12,000. 12,000 divided by 2 is 6,000. It's 6,000 per year. Multiplied by 1/12 will give me $500. This is the depreciation expense calculation. And this is a calculation I'm doing for the month for a single month. This calculation is for a single month. Depreciation expense debit, accumulated depreciation credit. So a mistake that you're probably likely to make is if you do not do this multiplication of multiplied by 1/12, that last calculation has to be done. Okay. In the second one, they've told the company recorded an adjusting entry of 12,500 for estimated future account uncollectible accounts. So they've just given us this information. We don't need to do anything further. Bad debt expense debit, allowance for uncollectible account credit, and it's 12,500 that was given to me. There's no need for me to do any calculation. Now for the third part, I was told that for the third journal entry, adjustments, I have to accrue interest on the note payable for the month of January. So let's first do the journal entry in terms of the debits and credits. I have to calculate interest. So it's interest expense debit. I'm not paying it now. I'm accruing it. So interest payable credit. So I need to find out what's the face amount of the note. And the note payable is $50,000. That's the face amount of the note. And the next question is, what's the interest rate? So if you go back over here, that was given 6% is the interest rate on the 50,000. So let me come back over here. And again, I'm going to show you my calculation. Let me insert a row here so I can show you that information. Okay, so again, I'm going to do this in different colors so we know it's an explanation. Interest expense equals the $50,000 multiplied by 6%, so 6 divided by 100, multiplied by 1/12. Again, we are doing the accrual just for 1 month. If you do 50,000 times 6%, that's the annual interest. I'm not going to pay annual interest every month. That'll be way more than the face value of the note then. Okay, so 50,000 times 6% times 1/12 gives me 250. 50,000 times 6% times 1/12 gives me 250. That's the interest I'm accruing on the note. The fourth piece of information says the company has accrued interest income tax at the end of January for 13,000. So this information has been given to us. We just need to plug those numbers in. Just like we did for the bad debt expense, for the numbers we just plugged in, this 13,000 I just plug in. It's income tax expense debit, income tax payable credit, 13,000. Finally, I'm told that by the end of January, $3,000 of the gift cards sold on January 2nd have been redeemed. They've asked us to ignore the cost of goods sold calculation. So basically what we're looking at over here now is, I'm going to scroll all the way up to the first one. In this journal entry, we had said cash debit, unearned revenue credit. Now we are saying the customer has redeemed $3,000 worth of gift cards. To the extent they have redeemed the gift card, my unearned revenues are going to decrease. And at this point of time, I can say I have earned it, so now I'll call it sales revenue. Okay, so I am done with all my adjusting entries. The next step is to put all this information into my T accounts so that I can create my trial balance. Okay, I have gone through the process of posting all the information, all the journal entries and the adjusting entries into the T accounts, closing those T accounts, and bringing the numbers, posting the numbers into the, they've been posted into the T accounts. Now I'm preparing my trial balance. This is the adjusted trial balance because it includes the adjusting entries. Make sure that your total debits and total credits are correct. If they're not correct, somewhere you made a mistake and you need to backtrack. Okay, so now that those steps are done, I'm down to preparing my financial statements. When I prepare my financial statements, there are several different ways in which we can handle this. And what I'm going to do is I'm going to look at my income statement and balance sheet. I'm looking at these two statements over here. And let me minimize this a little so I can get all the information on one screen, hopefully. Let's work our way through here. Prefer keeping this as a larger font so you can see what I'm doing here. Okay, so I will prepare my income statement first. We are preparing a multi-step income statement. In the multi-step income statement, as with all income statements, the starting point is always revenues. So my total revenues I have is 281, and that number you can see over here is 281. Okay. In the multi-step income statement, the next line you're going to put your cost of goods sold. Revenues minus cost of goods sold gives you your gross profit. That's the first number that you calculate over here. So I'm going to make this, I've also put these in uppercase to specify that these are subtotals over here. So cost of goods sold is 153,300. Now we know it is sales less cost of goods sold. If you put the parentheses, it's good. If you don't, make sure on before cost of goods sold, write less cost of goods sold. Not necessary, as long as in the calculations you have sales plus cost of goods sold, that gives you gross profit. In the next step, what we're going to do is we're going to list out all our operating expenses. I have three operating expenses: salaries, depreciation, and bad debt expense. Each of these I'm going to list in the inside column. These are inside and outside columns. That's all there is. I add them up. So I have 127,700 minus total operating expenses of 65,000. That will give me my operating income. The difference over here is 62,700. Next, I will list my interest expense. And this, I will now come up with the income before taxes. I still have another major expense to deal with. So before taxes, I have 62,450. Finally, I list my income tax expense to arrive at my net income number. So I have income before taxes less income tax expense gives me my net income. So what you see over here is we have gross profit, income from continuing operations or operating income, income before taxes, and the net income. These are extremely important, especially those of you concerned with finance. You need to look at these numbers. This interest expense, no matter what, you have to pay it. You borrowed money, you have to pay it. These taxes also on your operating income, on your taxable income, you have to pay those taxes. So for cash flow purposes, these are extremely important. You need to go through all of these very carefully. Okay, I'm going to now move over here and look at my balance sheet. Again, I'm preparing a classified balance sheet. In a classified balance sheet, I have assets, liabilities, and then I have the stockholders' equity. This, I should really have it consistent. So stockholders' equity. I didn't capitalize this, but the idea is assets equals liabilities plus stockholders' equity. Now, since we're preparing a classified balance sheet, I'm going to group my assets as current assets and long-term assets. The long-term assets, I have a property, plant, and equipment. So these are your two major categories, current assets and long-term. Liabilities, you have current liabilities and long-term liabilities. Stockholders' equity, we always have just these two items. We have common stock and retained earnings. Okay, so once again, when you look at your balance, your trial balance, you will see you have the following assets: cash, accounts receivable. This is a current asset account, allowance for uncollectible accounts, inventory. These are all your current assets. Land and equipment are your long-term assets, and accumulated depreciation is a current asset account. So let's put those numbers in over here. I'm going to highlight this section. So I have cash, accounts receivable, less uncollectible accounts, and inventory. That gives me my current assets. For property, plant, equipment, I have land, equipment, and less accumulated depreciation that's associated with the equipment. That's $2,000 over here. So at this point of time, I have my total assets number figured out. What we do know is total assets must be equal to total liabilities and owner's equity. So before we get to that, let's look at our balance sheet. We've taken care of all of these items here so far. So let me put this in this. Next thing we're looking at liabilities. Have accounts payable, notes payable, unearned revenue, interest payable, income tax payable. So all of these accounts are liabilities. Are any of them current or are any of them long-term really? Because they all look like current assets, current liabilities. Accounts payable by definition is always current. So it's only this notes payable. The notes payable, I'm going to go back again to the original problem and see what information was given to me. Notes payable is due on April 1st, 2025. We are doing the financial statements on January 31st, 2024. So it is more than 1 year. Therefore, it's long-term. A classification is important. Those dates are important for that reason. Why not? A little too far out there. Okay. So I know what my current assets are and my current liabilities. Only notes payable is long-term. All the others are current. I could have just written the notes payable on the outside and because that's the only long-term, but I'm just kind of being a little more specific over here. So I have my total current liabilities and total long-term liabilities adding up to 153,750. Now, common stock and retained earnings. Common stock, there was no common stock transaction that took place. So whatever I had on January 1st, that's the same number I have on the 31st. Retained earnings, I'll need to do a calculation. The calculation I need to do is retained earnings, I had 31,100. And then I earned income of 49,450. So my retained earnings number is going to be 82,550. So once again, let's see. Retained earnings is this number that we have over here in the trial balance. This retained earnings number, I'm going to highlight this one over here. We add net income to it to arrive at the final retained earnings number over here. Once again, retained earnings is what I had in my trial balance plus what I brought from my net income statement, the net income number. That gives me the retained earnings number. This now gives me the total stockholders' equity section. We have one last step to do. And that last step is to do total assets plus total stockholders. Total assets plus total stockholders' equity. We add up these two numbers. And it has to be the exact same number that we had over here. Running out of colors over here. Let's do this. Total assets must be equal to total liability plus stockholders' equity. So we are good with all of that. So we are good with our financial statements. Now, we also have to prepare our closing entries. And let's take care of that before coming to the ratio analysis. Closing entries, what do we close? We close all our income statement accounts and we close dividends if we had any dividends. So basically, it's revenues and expenses. So that should be fairly easy. I'm going to do that over here. My journal entry is January 31st, 2024. I start out by closing revenues, so debit revenues, and I credit retained earnings. And then I will do my second entry where I will close all my expenses, I close all my expenses and I close them to retained earnings account. Again, if you take the difference between these two numbers, it has to be that net income number. If we had dividends, then if we had paid out dividends, we'd close dividends as well. That's not the case over here. So that takes care of the closing entries. Again, you're closing revenues and all expenses. Remember, cost of goods sold is an expense. So pretty much everything that's in that income statement, not the calculations, calculated numbers. Again, what I mean over here is in the income statement, gross profit, operating income, income before taxes, net income, these are all calculated numbers. We don't close those. Those are not accounts. They're just subtotals. All the other accounts get closed. Now let's move on to the last part. Okay, now on to the last part where we're going to do some ratio analysis. We've been asked to calculate the current ratio at the end of January. Then we've been told if the current ratio average for the industry is 1.8, are we better than or worse than the industry average? Then we've also been asked to calculate the asset test ratio. And again, the industry average is 1.5%. Are we more or less likely to have difficulty paying our currently maturing debts? So let's put that to the side and do our own calculation. Current ratio is calculated as current assets divided by current liabilities. This is when this income statement balance sheet that we prepared becomes very helpful for all these ratio analysis. I have my current ratio total over current asset total over here. This total, right, I can just pull the number out from there. Same thing for current liabilities, where the number is 105,750. So if I do this calculation, what I come up with is 2.05. What were we told? The industry average is 1.8. Certainly, we are better than the industry. I'm having a little, there we go. If the industry is 1.8, we are better off than it. We are saying 2.05 is we have, for every dollar in current liability, we have $2 in current assets. So we're certainly better off than the industry over here. Now, quick ratio is quick assets divided by current liabilities. So I still have the same current liabilities in the denominator. In the numerator, let's take a look at those current assets. In the numerator, these current assets that we had, cash, receivables, inventory, we do not include inventory because they have not sold as yet. They have to sell and they are still removed from cash. So let's take that off our plate. Okay, so we are looking at 198,600. I took that 13,700 off. So I'm dropping the asset number. And now let's see what our number works out to. 1.91. And what did they say our industry average was? 1.5. Okay, so the industry average is 1.5 and we have 1.91. Most certainly, we are better off than the industry. Again, I almost have a 2-to-1 ratio, which is a very healthy number for anyone in the retail business. Now let's see what they tell us. They're asking us to make a change. Assume that the notes payable are due on April 1st of 2024 rather than April 1st of 2025. What happens to our classification? So go back to that classified balance sheet. What they're saying is this number over here, this number 50,000, it's not due next year. It's due 3 months from now. What happens is that becomes a current liability. It's current portion of your debts that are maturing. All 50,000 are maturing. Okay. So let's do the calculation again with our current ratio. Current assets divided by current liabilities. See what happens over there. Current assets are still the same that we had up over here. We're keeping those current assets. This number, 103,750, what does it become? 153,750, because we are including, this number now includes this 50,000. That's not good. I need to be ready with that extra 50,000. My current ratio drops from 2.05 to 1.38. If the industry average is still 1.8, the industry average is not going to change. I'm worse off than the industry average. Now, something to keep in mind, anytime a company has a long-term liability, it should not be a surprise that this liability is going to be due. So they should be prepared for it, and they should have money set aside for it. They shouldn't be using money from current assets in order to pay a long-term liability. So if they have money set aside, then they are fine. That's not uncommon where a company may have a new borrowing to pay off the old loan. Kind of robbing from Peter to pay Paul. But again, if that arrangement has been made, then in the notes to the financial statement, you can say, I'm not including this, although it's due in 3 months, because I have a separate financing arrangement. Again, what we're looking at is based on how you classify some of these numbers, your ratio analysis could change. So hopefully this gives you a good overview of the accounting cycle.